All right, so joining us now is Christyan Malek, JPMorgan Global Head of Energy Strategy. All right, Christyan, that sort of comes as we get OPEC Plus next week. You were just in Saudi Arabia. What do you think we're going to see?
Well, Alex, I mean, there's always some narrative surrounding upcoming OPEC meetings. And having just been back to the community, you say this morning, I can tell you this: whether they decide to cut, do nothing, to add, I think know this: the highest common denominator for OPEC is to mitigate the downside and reduce volatility. And I think their track record says it all. I mean, they've proven correct with every move they have made, including the last. And some-wise, I think, having just been there, central banks around the world could learn a thing or two from the Saudi Energy Minister, Prince Abdulaziz.
He is, though, talking about maybe wanting to inflict a little bit of pain on the shorts. If he wants to inflict a little bit of pain, Christyan, doesn't he need to deliver a big cut? Because thus far, those kinds of threats have been fairly ineffectual.
Yeah, I think in the end, the short speculators will always be there. It's whether they're a dominant feature or whether they're sort of in the mix. I think oil is being used as a proxy for inflation hedging at some point in the past. Now it's being used as a proxy for recession. It's kind of been used as an asset class for all the wrong reasons. And the danger with that, guy, is that what happens is the volatility goes to max. The industry itself, which uses oil as a revenue line, doesn't invest because of that, and we see much higher prices in the future. So I think it's less around trying to remove the shorts. It's more about trying to reduce massive volatility in the future and massive inflation for consumers. Because in the end, if we don't see investment today because everyone's terrified because of the shorts, we're all going to pay for it later in much higher prices, where everyone loses in the end, especially the consumer.
Which is why it's so interesting to see, how the M&A is evolving. So Chevron earlier this week bought PDC Energy. This is a great deal for Chevron. It just helps them maintain kind of their production, but doesn't like grow. This is not like a transformational investment, yet it was over a $6 billion deal. Like, this is where we're spending our money now, rather than we're going to put a lot of money into deep water, guys.
So are we at the point now where it is better, it is easier to find oil in the stock market than it is in the ground? Maybe not easier, maybe cheaper, Alex.
I totally agree. I mean, you introduced the idea of volatility and removing the shorts, and in fact, the danger of all this is the WACC, the cost of capital of oil, so to speak, goes up. And so the incentive to invest and build massive production runways over 10, 15 years, especially with the ESG pressure, especially with emissions pressure, and especially with shareholder pressure, is simply that you say, why would I bother? I'll just buy an asset. And the fact that this asset is bought, I mean, the productivity profile of this asset, I wouldn't say it's top quartile. It says it all. It says that we are now running short of shale volume growth in terms of investing, and I think it's very bullish. I mean, this year we put the super cycle on hold, but on the medium term, we think shale is going to plateau out in 3 to 4 years. And really, the only place the world can look for additional black oil will be OPEC.
So you did just have your energy outlook, or global energy outlook. It's the second time you've done that. Why have you pushed out the super cycle thesis? Is that demand driven? Like, what surprised you?
Absolutely. It is demand-driven. I mean, demand is king of the complex. We sort of have to sort of be humble when we do this work on analysis around energy shortages. But the reality is, and we coined the trilemma term back in 2018, and there was a report where you're introducing the energy quadrilemma. Now, what is that? Well, it's the generation of energy, the energy system to get the energy to the consumer, the government policy, which isn't consistent with fuel, and finally time. Energy transition is going to be a multi-decade, if not a multi-generation process. So I can be concerned about demand in the near term, but my major concern, having zoomed in on the energy system, is we're practically lack all materials, technology to get clean energy to the consumer in time. So you can generate as much as you want. And the danger of that is you see energy demand growth continuing after this 12 to 18 month kind of pause because of the recession and somewhat inflation. Then it roars back over the decade. And we have extreme energy shortages over the coming years and price volatility, especially in.
So, Alex, this is interesting because this takes us back to the question we were asking earlier on this week. Is Europe setting itself up for another energy crisis? A lot of the investment in renewables is going to the States, and you do wonder whether, therefore, the States has a lead. It's also got some of the gas, which Europe is going to struggle to get And you do wonder whether therefore, actually the epicenter of the crisis, if we kind of follow Christian's line, is going to be in Europe.
Yeah, that's an interesting point. And Christian, in your piece, you basically are looking at a $1.3 trillion CapEx call, but the majority of that comes actually from power generation. And I'm interested to see where you see that capital being deployed.
In fact, it's not only it's 1.3 trillion of incremental spend, which we're not spending. If you look at then where we spend it, it's the metals, it's the technology around storage, it's the grid. Where does all that live? It lives in China. So we're basically massively dependent on China for the energy system. We can generate it in the West. We can produce solar energy and wind. But if you need the system, you need metals. So the energy transition itself is going to see a major energy demand shock, which we can't solve for because we need the energy and we're not producing it. And it all comes back to what energy do we have today to solve for it? What metals do we have today to solve for it? The energy, if it's oil, sits with OPEC. The system, if it's the materials, sits in China. So we're setting ourselves up in a way where, coming back to Europe, they can solve for the near term in terms of sort of either taxing the industry or subsidizing it through for the consumer. All we're doing is kicking the can down the road to major energy shortages in the second half of this decade. And so we're sort of sleepwalking into it.
So Christian, how do you play it short and long term? When you can't get oil prices to get a bid, how do you play the oil majors? And then what do you do with like the BPs and Shells of the world, where investors just don't like their alternative investments as much?
Ultimately, you want to be playing it through being massive, I think, exposed to companies who can grow their energy, but the right source of energy on the right source of cash returns. So anyone that can grow volume growth in oil and gas, at the same time as being able to decarbonize through clever ways, through technology, at the same time as generating cash flow. You can't have one without the other. And I think you're right around the European majors. The risk is they're transitioning, but they're leaving the cash behind in terms of cash return. So if I look at that, who's got the greatest cash return? Who's got the most volume growth in oil? Who's got the ability actually to think about and solve for decarbonization? It's Total Energy, Shell, and then in US, Exxon and Oxy. They have real oil volume growth and have committed and still have a reserves life with a runway. All the others, I mean, a lot of the others
Christian,
are struggling to grow.
Why don't I buy oil companies because they're oil companies and renewable companies because they're renewable companies? Why don't I just play it that way? Then I understand where the risk lies.
Exactly. Stick to what you know. And I think if there's going to be an energy shortage, you want to be playing where we short generation and where we are short system, because ultimately that's where the value of the arb is. In energy generation, we're short oil predominantly, therefore you want to be playing companies in that category. In the energy system, we're short everything to do with technology and storage in carbon capture. So you want to be long the companies who are delivering that technology, carbon capture companies that can deliver storage. So it's sort of like a barbell. But you've got to be very specific where you take that bet on the equities.